Hi friends, today let's learn about secured and unsecured loans. Loan, as we all know, is defined as the lending of money from one individual, organization or entity to another individual, organization or entity. In a loan, the borrower initially receives or borrows an amount of money called as principal from the lender, and it is obligatory to pay back or repay an equal amount of money to the lender at a later time. The loan is generally provided at a cost, referred to as interest on the debt, which provides an incentive to the lender for lending money. While learning the basic concept of secured and unsecured loan, let us also study the evolution of the concept of loan and the interest on loan. The concept of loan is in existence since the existence of mankind. Early loans and interest were based on agricultural produce. From about 30,000 BC, human existence became more refined until the social and economic reforms of agriculture appeared around 10,000 to 7,500 BC. Friends, can you imagine that the loan in the pre-urban societies were made in seed grains, animals and tools to farms? Since one grain of seed could generate a plant with over 100 new grain seeds. After the harvest, farmers could easily repay the grain with interest in grain. In this period, animals were loaned. Interest was paid by sharing in new animals born. The Egyptians called interest as to give birth. So, it was stated that what was loaned had the power of generation and interest was sharing of the result. Interest on two loans would be paid in the produce which the tools had helped them to create. Till this period, coins had not been introduced. So, the loan was taken by way of goods and was also repaid by way of goods produced. But during this period, it was very difficult to consider and repay loans. So, if a farmer needed the grain produced by his neighbor, he took the grain and returned it with more grain produced from his farm by way of repayment of loan with interest. Sometimes, if he needed help on his farm for reaping or sowing, then he repaid the person by giving him grains produced from his farm. After this period, for supporting the transactions, coined money was introduced. But after the introduction of coined money, the situation became more difficult, as it was needed to take a loan of money to purchase his necessary supplies. When a year of plenty came, he undertook to repay the loan. If such a debt was not cleared due to bad weather or a poor harvest, it would bring foreclosure of their land and even bind them to slavery. Due to this increase in the number of slaves, Solon, the great Athenian statesman, lawmaker and poet, declared that personal slavery was no longer allowed as security for debts. He also introduced minimum monetary value for each agricultural product, setting floor prices for each of the agricultural products. During this period, the actual form of monetary loan was introduced. This was in 594 BC. Later, in 390 BC, Aristotle, a Greek philosopher and scientist, understood that money is sterile. It does not beget more money, the way cows beget more cows. He knew that money exists not by nature but by law. It was stated that money was intended to be used in exchange but not to increase. In this time, the term interest, which means the birth of money from money, is applied to the breeding of money. because the offspring resembles the parent was introduced. This concept of interest introduced was not easily acceptable by the society, as the church, pope and other scholars condemned the concept of interest. Life was also called as a loan from God, and death was called as the final repayment in the same period. Later in this period, sellers started selling goods on credit and generated bills of exchange, on which they levied interest. Thus, it was realized that money can also generate money. The modern times interest has been defined as: interest is the charge for the privilege of borrowing money, typically expressed as an annual percentage rate. There are two main types of interest that can be applied to loans: simple interest and compound interest. Now friends, let's define loan in two basic criterias. This bifurcation is made according to the period of which the loan has been taken. The credit facility repayable in installments over a period which is more than 1 year is termed as loan, while a credit facility repayable within 1 year may be known as an advance. When any person or corporate takes a loan, he has to provide a security on the loan taken. But when he takes an advance from banks or from individuals, it may or may not be secured. Let's look at an example. Mr. Joshi wanted a loan of rupees 30,000 for a period of 3 years, and he was going to repay the loan over a period in equal 6 monthly installments. Now the question arises that will the amount taken by Mr. Joshi be treated as a loan or an advance? Now, the amount which has been taken by Mr. Joshi is for a longer duration, that is more than 1 year. This amount will be repaid by him in equal installments over a period of 3 years. Thus, the amount will be termed as a loan and not as an advance. Friends, there are different types of loans available. Let's see some of the types of loans in detail. Personal loans. A personal loan is a type of unsecured loan which is given to a consumer to cater to any of their personal needs by buying a vehicle, home appliances, for renovation, etc. It is given after verifying your ability to pay, particularly the source of income, and also as per your credit history. Some processing fee is charged and the amount gets credited to your account. The payment of the loan is made through fixed installments, including interest, for a fixed period of time. There are many advantages for getting a personal loan, like these loans are easily available. For getting these loans, middlemen, mediators or agents are not required. The processing time required for getting this loan is less. For personal loan, it is not mandatory to specify the cause for taking a loan, so the money credited can be used for any purpose. The amount, tenure and method of payment is decided by the client. Though a personal loan has many advantages, it is backed with many disadvantages also. Some of the disadvantages of personal loan are: eligibility criteria is required for a personal loan, and this criteria is different in every bank. A good credit history is essential for getting a personal loan. Having a bank account is mandatory. As it is an unsecured loan, the risk is quite high for the lender. So, if you are one who has a good credit history and have means to repay the amount borrowed with interest, then you can easily get a personal loan for a purpose you require. If you do a bit of research, you may be able to strike the best deal in terms of interest rates and also apply for your personal loans. The next type of loan considered is term loan. Term loan is a medium term source financed primarily by banks and financial institutions. Such a type of loan is generally used for financing of expansions, diversifications, modernizations of projects. So, this type of financing is also known as project financing. Term loans are repayable in periodic installments. So, the feature of term loans are the term loans are secured loans. Repayment is done in installments which consist of interest and principal. Term loans carry a fixed rate of interest, but this rate is negotiated between the borrower and the lender at the time of disbursing the loan. Lenders ask the borrowers to maintain a minimum asset base, not to raise additional loans or repay the existing loans, etc. Term loans may be converted into equity at the option and according to the terms and conditions laid down by the financial institutions. Borrowers as well as lenders have many advantages in taking a term loan. Let us list these advantages one by one. From the viewpoint of the borrower, yearly repayment of principal and interest. So, the basic amount of loan goes on reducing every year. The rate of interest is known to the borrower. So, the internal rate of return of the concern can be kept at a higher or greater level than its cost of capital. It is a cheaper source of medium term finance. Interest payable on term loan is a tax deductible expenditure and thus taxation benefit is available on interest. Term loans are negotiable loans between the borrowers and lenders. So, terms and conditions of such type of loans are not rigid and this provides some sort of flexibility. Since term loans represent debt financing, the interest of the equity shareholders is not diluted. From the point of view of a lender, term loans are provided by banks and other financial institutions against security. So, term loans are secured. It is obligatory on the part of the borrower to repay the interest and repayment of principal irrespective of its financial position. Hence, the lender has a regular and steady income. Financial institution may insist the borrower to convert the term loan into equity. Therefore, they can get the right to control the affairs of the company. But it also has some disadvantages. They are like, from the point of view of the borrower, on non-payment of the installment, the borrower's existence will be at stake. Like any other form of debt financing, term loan also increases the financial risk of the company. In addition to the collateral security, restrictions can also be imposed by the lender which leads to unnecessary interference in the functioning of the concern. From the point of view of the lender, terms and conditions of term loans are negotiable between the borrowers and lenders and thus it sometimes can affect the interest of lenders. Like other sources of debt financing, the lender of term loans do not have any right to control the affairs of the company. Now, let us discuss about the short term loans, which is called as a cash credit. Cash credit is a flexible system of lending under which the borrower has the option to withdraw the funds as and when required and to the extent of his needs. Under this agreement, the banker specifies a limit of loan to the customer known as the cash credit limit, up to which the customer is allowed to draw. The cash credit limit is based on the borrower's needs and as agreed by the bank. Against the limit of cash credit, the borrower is permitted to withdraw as and when he needs money, subject to the limit sanctioned. It is normally sanctioned for a period of 1 year and secured by the security of some tangible assets and personal guarantee. If the account is running satisfactorily, the limit of the cash credit may be renewed by the banker at the end of the year. The interest is calculated and charged to the customer's account only on the amount which is utilized by the customer. Cash credit is one of the type of bank lending against security by way of pledge or hypothecation of goods. Thus, a cash credit is a secured loan, which in form of sanction, where the customer can decide the utilization. The banker charges interest only on the amount utilized. Now friends, let us study the meaning of one of the bank advances called as bank overdrafts. Overdraft facility is more or less similar to cash credit facility. Overdraft facility is a result of an agreement with the bank by which a current account holder is allowed to draw over and above the credit balance in his account. It is a short period facility. This facility is made available only to current account holders who operate their accounts through checks. The customer is permitted to withdraw the amount of the overdraft allowed as and when needed and to repay it through deposit in the account. Let us see the second type of advance, which is called as discounting of bills. Apart from sanctioning loans and advances, discounting of bills of exchange by bank is another way of making funds available to the customer. Bills of exchange are negotiable instruments which enable debtors to discharge their obligation to the creditors. Till now, we were discussing about the types of loans. Now, we will discuss the basic concept of security in a loan. Considering this point of security, while granting a loan, the bank divides the loan into basically two types: secured loans and unsecured loans. To ensure the safety of funds lent, the first and most important factor considered by a bank is the capacity of the borrower to repay the amount of the loan. The bank therefore relies primarily on the character, capacity and financial soundness of the borrower. But the bank can hardly afford to take any risk in this regard, and hence it also has security of tangible assets owned by the borrower. In case the borrower fails to repay the loan, the bank can recover the amount by attaching the asset. It can sell the assets offered as security and realize the amount. Unsecured loans are those loans which are not covered by security of tangible assets. Such loans are granted to firms, institutions against personal security of the owner, manager or director. Secured loans are those which are granted against the security of tangible assets like stock in trade and immovable property. Thus, while granting loans against the security of some assets, a charge is created over the assets of the borrower in favor of the bank. This enables the bank to recover the dues from the customer out of the sale proceeds of the asset, in case the borrower fails to repay the loan. There are various types of securities which may be offered against loans granted, but all of those are not acceptable to the bank. The types of securities generally accepted by the banks are tangible assets such as plant and machinery, motor van, etc., bills of exchange, financial securities like shares and debentures, life insurance policy, real estates like land and building, fixed deposit receipts, gold ornaments, etc. Now friends, we just saw that financial securities are also considered as a mortgageable property. So let us see in detail the use of securities for getting a loan. The Reserve Bank of India allows banks to lend up to 65% of the value of demat shares and 50% of the value of physical shares. However, banks can fix their own limits with respect to the extent of funding with that range. Generally, demat shares fetch a larger loan amount in a much faster time, at lesser rate of interest, at smaller processing fees than those in physical form. Loans against mutual fund units are based on their net asset values. Let's see some practical situations. Mr. Ram wants a loan of rupees 40,000. So, he approached State Bank of India for getting a loan. The banker inquired about the financial status of Mr. Ram and also inquired about the usage of the loan. Mr. Ram told the banker that the loan was required for a purchase of a new lathe machine in the factory. So, the banker inquired about the mortgageable property which Mr. Ram could submit for getting a loan. But Mr. Ram had loans from other banks, so he did not have any other fixed assets. Now, the question arises, what are the different alternatives Mr. Ram can think about for getting a loan from State Bank of India? Can a bank grant a term loan without a mortgageable property? In this situation, the banker has realized that the fixed assets owned by Mr. Ram are already mortgaged for getting a loan from different bank. The solution can be, if Mr. Ram wants to take a term loan from State Bank of India and he does not have any other fixed assets left for giving as mortgageable property, then Mr. Ram can also think about his investments in shares, bonds, mutual funds, fixed deposits, etc. These investments can be offered by Mr. Ram as a mortgageable property for getting a loan. This is required as bank cannot grant him a term loan without pledging a property with the bank. Let's see a second condition. Mr. Shyam has a Xerox center of his own. He wanted to buy a Xerox machine to replace the old. He decided to go to Bank of Baroda for getting a loan for a period of 5 years. The banker demanded his previous year's financial statements and also asked him to submit the papers of his property which he could mortgage. His friend Mr. Govind came as a guarantor of the loan. Now, the question arises, what will the bank do if Mr. Shyam is not able to repay the loan? And what is the liability of the guarantor? Solution: after receiving the loan, if Mr. Shyam becomes a defaulter, then the bank will send him reminders about the payment to Mr. Shyam. But if still Mr. Shyam is unable to pay the amount of the loan, then the banker will intimate Mr. Govind, the guarantor, about the default and is asked to repay the amount due to the bank. After several intimations and reminders, if Mr. Govind does not pay the remaining amount of the loan, then the property which has been mortgaged with the bank shall be sold by the banker for recovering the amount of the loan. If the property is sold at a higher rate than the remaining amount of the loan, then the remaining amount after repayment of the loan is transferred to Mr. Shyam's account. By now, you must have understood the basic concept of loan. Thank you friends for being patient listeners. Thank you friends.